Hey everyone, welcome back to the channel. This is part 3 in our series of performing due diligence. Part 1, part 2, we went over a lot of just how to find company information out of the 10K. In this part, I'm going to talk about kind of the value of looking at competitors and some things to think about and how to really pull this data together. This video took a lot longer than I was anticipating. Normally I use Capital IQ, which is a paid service that I have access to pull down comps, and it has all these statistics calculated for you. But I went ahead and did this manually, and I'll show you how to do that for one company, but it's the same process kind of repeated. So I think the first thing we need to talk through here, though, is how to select the comparable companies. So the company we're valuing is Walmart, and Walmart is a retailer. They primarily have three segments. They have in-store sales, e-commerce sales, and then wholesale sales through Sam's Club. So when we kind of think about it, wanted to break this out by two kind of categories here. So I have retail, which is kind of the traditional retailer slash wholesaler. So Target, Kroger, Costco, just kind of selling, everyday products. Target is probably the closest competitor or peer comparison to Walmart's core business. Costco is going to be the biggest core competitor to their wholesale business, and then Kroger is obviously a large grocery store retailer, and Walmart also has a lot of grocery sales within their broader stores. So this is kind of that like retail brick and mortar segment. And then the second segment I broke out is e-commerce slash specialty retail. So the reason for this is just to kind of see how does Walmart compare. So first off, e-commerce, the big one on that space is Amazon, but that gets a little weird to compare directly because Amazon also has a big cloud business. And then you have Best Buy and Lowe's. So from a specialty retail standpoint, I would expect that a specialty store might have better margins or something like that. So just something to kind of compare to. Now, when thinking through how to pick your competitor companies, there's a few different ways you can go about this. If you read through a 10K, sometimes they'll actually just directly list their competitors. Another thing you can do is you can honestly just go to Google, um, and this is a great resource, and you can type in Walmart competitors and kind of see what comes up. So top competitors, eBay, Retail Group, Albertsons, Kroger, Lowe's, Costco, Target. So you can see a lot of the things I have, comes up in this first Google search. That's another way to look at it. Anything that you think might be interesting to compare against. So if for some reason you just have a specific company in mind, even though it may not be on a list, something you could pull in. But I think the big thing to remember is you're looking for something that's in a very similar space as your company. And then also, if you can find things that are around the same size, that's helpful. And you can tell, for Walmart, that's kind of tough. Walmart is a $400 million market cap company. And a lot of the competitors in the traditional retail space are smaller. And then in the specialty space, much smaller. But then Amazon is obviously much larger. So it's kind of hard. There's not necessarily a good, perfect, and there will never be a perfect competitor. But the idea here is we want like a good range of companies to kind of look through and think about, and then we can compare metrics and see how our company compares. So we'll kind of jump into it now, and I'll walk you through this table I have set up, and you can download this file, and this table will be on there. But always start with the company, the ticker symbol, current share price, and these are as of I think last Friday, which would have been the 9th, the 52-week high, percentage of the 52-week high. So we can group this column. The idea here is just to see, are they trading near the top end or the low end, right? So if you're kind of towards the lower end, right, Best Buy, maybe that signals something that, negative sentiment around Best Buy, as opposed to trading at the higher end, obviously positive sentiment, setting all new highs. Just something to kind of look at. Equity value, this is the market cap. This comes directly from Yahoo Finance, and I'll show you that real quick. So if we this would have been pulled, market cap 393.926. You can see it's changed a little bit because my numbers are as of last Friday. Share price as well, a little bit off, but same thing there, just from last Friday. Enterprise value, this is a calculation. If you're not familiar with enterprise value, it is the market cap of a company plus its debt less its cash. So this is a formula linking to this comparable data tab, and we'll go to there in a minute. So what enterprise value really represents is the total cost to purchase 100% of the company. So what that means, if you bought all the stock for $393 million or billion dollars, you still wouldn't own 100% of Walmart because they have outstanding debt, and those debt holders have a claim to a portion of the company in the event of a default. So you'd have to go pay back all the debt, and then when you buy the entire company, you would get their cash on the balance sheet, and in theory, you would use that cash to pay off the debt. Now, it can be a little bit more complex than that if there needs to be, if you need to keep cash on hand, which Walmart would, but that's just a little bit like, they have to keep their tills at the store, cash in them, probably have to keep some amount of cash for liquidity needs, but that's another discussion. This is just a very simple understanding of enterprise value. And then we move into a lot of different metrics. And you can pick whatever metrics you want as long as they kind of make sense. Some very common ones that you will see, or that I worked with in investment banking, would be enterprise value to revenue, EBITDA, and EBIT. Those were very common. You'd look at net income percentage, revenue growth, EBITDA growth, EBIT growth. So I mean, these were all just kind of very common formulas that we used. Some other popular ones would leverage free cash flow, kind of looking at the free cash flow conversion, things like that. Um, and real quick, I'll give you an example. This is one I pulled together on Tesla a long time ago, and you can see very similar formula, but you're right, I picked a bunch of large auto manufacturers, and I actually added in, if we look at it, cars produced, cars sold, and electric vehicles delivered. Now, for Tesla, that's an important metric, right? We want to see how many cars they produced, how many cars they're selling annually, how many of those are electric vehicles, right? To kind of see their scale versus their competitors. And then this was just a much more traditional enterprise value to sales, EBITDA, and EBIT. And you'll see in here I have future years, 21 and 22. If you have the ability to pull that data, I would encourage you looking at future projections and then the multiples there. The reason being is in growth companies, their current multiple may look a little bit ridiculous, but if their revenue is growing 100% year over year, then that multiple will drop drastically. And if we look at someone like Tesla, right, this bottom line here, row 22, LTM EBIT, they trade at a 320 times multiple. Based off estimated 2021 EBITDA or EBIT, right, it drops in half, and then it drops again by 33%. So something to think if it's a high growth company. Anyways, back to the Walmart one. So here's all the different metrics I've picked, and all these black cells, they do link back to this comparable data tab. And you know, really what we're trying to get at here is, how does Walmart compare to other companies it competes against from an operational standpoint? Do they have any advantages? Are they operating more efficiently, less efficiently? This is useful information as we go to build out a valuation to understand if there's potentially room for improvement. So if we kind of look at it, and I'll walk through how we get all this data here in a minute, but enterprise value to revenue. So this is really, how many multiples of revenue are they trading at? 0.75. And if we look at the mean and the median for all 6 of these comparable companies, they're below that. So that means they're kind of trading at a discount in a sense, right? I mean, Best Buy is lower than them, and so is Kroger. But outside of that, everyone else is trading above them. Obviously, Amazon is an outlier here, I would say, and probably so is Kroger, because Kroger is groceries, incredibly low margin on just purely groceries. So there's that aspect. Same thing with EV to EBITDA. We would expect to see a similar trend. If they're trading at a lower EV to revenue, they're probably trading at a lower EV to EBITDA, unless if they have a really impressive EBITDA conversion. But as we can see, they actually are trading similar, lower than their competitors. And we'd expect the same thing for EV to EBIT. And this is something to just kind of look at and see, like, are they trading, how are they trading? Is it different at all? Is there anything that's kind of anomaly? What could be driving that? And then if we look at price to earnings per share, so this is the PE ratio. How are they trading there? They're trading at 30 times earnings, or 29.4, I guess. And if you look at, like Target trades at a very similar ratio. Costco's a little bit higher. Amazon obviously much higher. Best Buy and Lowe's though, kind of about the same, and Kroger low. So, what we're really trying to gauge here is how are they trading in comparison to their peers? And right now it looks like on most of these, they're kind of in the middle. Gross margin, right? So this is, if you're not familiar with gross margin, this is just revenue less COGS. So they have a 25% gross margin. Is that higher than a Target? I'm actually surprised to see that they're lower. Or, I mean, I guess I'm not surprised, but and the reason I say that is Walmart prides itself on its everyday low prices, right? That's like their motto, their slogan. So they are going to have lower prices than someone like Target. And because of that, they'll have a lower gross margin. But is 5 percentage points too much? Is that reasonable? That's a whole nother question. And then Costco, obviously being a wholesale club, is going to have lower um, because they sell it kind of like a cost plus model, pretty standard. And then, right, as I was saying, like Lowe's is at a higher gross margin because they're a specialty product. Best Buy is actually a little bit lower, which is surprising. So, I think these are all really important things to look at, right? EBITDA percentage, this is kind of the conversion to EBITDA. So 6% of revenue becomes EBITDA compared to peer companies. That's Lowe's does better, Best Buy and Amazon do better. So, I mean, they're kind of in the middle again. EBIT percent, similar story, right? How much of their EBIT is staying after revenue? So from revenue to EBIT, 4%. Net income percentage, 2.4. So 2.4 is kind of flowing through to the bottom line. How does that stack up? And you can see it's pretty low. Second lowest, only higher than Kroger, which is a grocery store, which I would expect to have the lowest. And then revenue growth, right? So this is kind of more last year's metric, 6.7% growth. Comparing that to everyone else, they have the lowest. I think that's a little bit alarming. During the pandemic, people were buying a lot of cleaning supplies, groceries, hoarding stuff. Surprised this isn't higher. And, is there an anomaly there? Is there not? This is really just to kind of set us up for probing questions to try to figure out what's going on. And if you remember in part 1 and 2, we talk about how they're divesting their UK and Japan and Brazil businesses. So I would guess that a lot of the revenue growth is because they're no longer reporting those divested businesses. So that's probably what's happening there. So maybe that's not as bad as it sounds. EBITDA growth, similar thing, right? Much lower than everyone else. Is it from the divestitures? Is it not? So, you could try to neutralize it out, something like that. And then, we get similar things, and then we get to EBIT, debt to EBITDA. So how many turns of debt do they have really? 1.32. So, a little bit lower than, I mean, obviously Amazon, Best Buy pretty low, but Lowe's is pretty levered in comparison. So is Kroger, and Target's a little bit more levered. So kind of once again, right in the middle. And the last two, ROA and ROE, so return on assets and return on equity, just kind of how efficient are they with their assets and with shareholders' equity. Usually, so I was kind of lazy when I calculated this, and it's going to be we follow this formula, right? L5 divided by P5, L net income divided by total assets. Now, normally what you would do is you would take the total assets at point A in time, which is like the current time, and then you would do it a year before, and you would take the average of those and then divide the net income over the average because the balance sheet is a snapshot in time, and the assets are kind of always changing. The same with shareholders' equity, but we can see they actually have pretty low ROA, basically the lowest on the list besides Kroger, and they have absolutely the lowest ROE. So just something to consider. So, the whole idea of pulling this together, though, is really for us to be able to take a stance and say, how are they looking compared to competitors? Do they have any operational efficiencies? Do they have a moat? Is there anything they're doing differently that's, value add and, that they're doing really well? And you have to look at the competitors and their stats. So I'll show you now how we pulled this together. So here's the data I pulled. So we have CY stands for current year, and then CY minus 1 is current year minus 1. Now, another way to do this is to do it on an LTM basis, so last 12 months. To be honest, it was way too much work, so I just did it based off the year, because to do by month, you'd have to go into each 10Q, and you'd have to pull the monthly numbers and sum the last 4 Qs, and you'd have to go through 4 10Qs for each for each company, as opposed to if you do it on the year, you just go into the 10Ks and that works. But let me show you how we pulled the numbers for Walmart, and it's the same process for all of them. So first what we're going to do, we're going to head on over to sec.gov. You're going to click more search options, type in the stock ticker. So let's do WMT, filter for 10K, and we just need the most recent 10K. So we'll open that up, and really where we're going to scroll in all these table of contents, you'll be able to click down to financial statements and supplementary data, and we will scroll down. And we'll just start with the top part. So revenues, 2021. So total revenue, 559,151. So if we look at current year revenue, this is just a direct copy over. And then if we look at prior year revenue, same thing, 523.96, 523.96. So that'll give us current year revenue. Gross margin, this is something we actually have to calculate. So I take the 559.151, and then we're going to subtract out the cost of goods sold. So here they have costs and expenses. Now operating, selling, and general and admin, this is really their SG&A cost. So not necessarily the product sales. So we only really care about the cost of sales here. So we're going to go ahead and take the 559,151 minus 420,315. That's going to give us the 138.84. Now the big thing here is just to be consistent as you go through 10Ks. Some of them will give you actually a gross margin on their breakout, some won't. But just be consistent in how you calculate it for each company and you won't run into any issues. So same thing, if we calculate the prior year, same formula, the 523.964 less the 394.605. Now net income, this is easy. This is just going to be on the bottom here, 13.510 and then 14.881. And actually don't even know if I calculated prior year's net income because I don't look at the growth there, just used it for the ROA and ROE. Now EBIT will be the next thing we calculate. And so I use operating income actually as a proxy for EBIT. So if you're not familiar with EBIT, it's earnings before interest and taxes. So before interest, which we can see is down here, and then taxes. So it's basically like how profitable is the company from its pure operations. So usually it's going to be revenue, less COGS, less SG&A, and that will give you EBIT. So that's what I use as a proxy. I use operating income for EBIT, and if I saw any interest or anything kind of above this line, I would back it out. And then for EBITDA, which is the next thing we calculate, I'm going to take my EBIT, and then I'm just going to add back depreciation and amortization. So we're going to take this 22.548, and then we're going to add back D&A. And D&A will be listed on the cash flow statement. So if we scroll down here, we will get down to the cash flow statement, and then we'll see depreciation and amortization of 11.152. Now, you could also add back some other non-cash expenses as well, anything like that. But I think for the point of this, I think we wouldn't need to, but sometimes there could be some other like amortization of intangibles or something. I'm not seeing that on here. It might be a smaller number, but so I just grabbed depreciation and amortization to keep things constant to calculate each company's EBITDA. Current year EPS, once again, this is going to come off the income statement. It'll just be on the bottom. And I just used basic, where is it? 4.77. You could do diluted. It'll be a couple cents off on everyone. Just stay consistent throughout. It's not going to make a huge difference. If you keep it constant for all the companies, then your multiples will be relatively the same. Total assets, this is just going to come from the balance sheet. So we'll go assets, total assets 252,496, and then shareholders equity, again, this is from the balance sheet. So total equity 87.531. So, and then we just calculate those, pull over the same ones for the prior year. So in the most recent 10K, they will always have the current year and the prior year results. So it'll all be in this one file, and you'll do that for all these companies. So you can see how this is pretty time consuming, to be honest, to go through all these different 10Ks, pull out the data. If you were to do it on the LTM basis, as I mentioned, you'd have to do four files for each company. So it quickly becomes pretty repetitive and pretty tiresome. I would recommend, honestly, trying to find a good stock screener or something like that. So if you were to go to Google and just type in like stock screener, Um, I use Cap IQ, but I'm sure there are some free ones. So, I mean, it looks like Yahoo even has one. I don't know if you can add specific companies or anything. So definitely just kind of poke around and look around online. But if we just did like small cap, find stocks, let's see what happens. I'm sure it's going to give me, right, a handful of different metrics here. I wonder if you can add, it looks like you can, right, you can add like PE, you can add total assets, total common equity, current liabilities, debt to equity, total debt to EBITDA, net debt to EBITDA. So it looks like a lot of what we have, you can actually kind of just add, um, right? And then we can kind of see that actually, yeah, it looks like that should have added them. Um, oh, this is greater than, I don't know if it's going to add it into the actual table, but I'm sure there's, let's see what's fin is. Does this give us, let's see, screener. Can you adjust? So it gives you like PE, price change, click on the valuation, right? And this will give you different valuation metrics, right? EPS this year, next year, price to free cash flow, price to book, um, financial ratios, ROA, ROE, ROI, and you can probably change these. So, this might be a great resource to, once you probably set up the screener, you could probably save it if you create a profile, and then it's easy enough to just change the tickers and you kind of have a standard output as opposed to calculating it by hand. But it is good to calculate it by hand at least one time, kind of see what you get to. And let's see what happens if let's do Walmart and let's see how far off we are from what they kind of have listed for anything. Do they have ROA 5%? What did we calculate ROA at? 5.35. ROE, they have it at 15.5. We have it at 15.4. So you can see we're actually pretty close to how they're calculating it as well, but there's a little bit different. Gross margin, 25.1. We have 24.8. So they're doing a little bit of adjustments there. But you can see we're directionally getting the same thing. Do they have, let's see, EBITDA? Do they give us an EBITDA anywhere? But yeah, I mean, this seems actually like a pretty good, um, it looks like you do custom. You can, yeah, you probably just pick all sorts of stuff. So yeah, I think this might actually be a really good resource for someone if they're, don't want to, slog through all the financial data. But I think it is good to do it once, understand how to pull this together so you're capable. And if there's a different metric you want to see, just Google it, right? If you want to learn how to calculate free cash flow, Google it. It'll give you the formula, and then you can go through the financial statements in their 10K, and you can calculate it. Um, but yeah, so this really wraps up kind of the competitor piece. This is something I always do when pulling or performing due diligence. It's good to understand kind of the space, the competitors, and see how this company really compares to everyone else and understand like, are they as efficient, less efficient, anything of that nature, anything that stands out. And what I'm seeing here is Walmart is really middle of the road when I compare them to these retailers. So what that leads me to believe is if I do a valuation and I see that they're kind of fundamentally undervalued, maybe it's a buy because they're performing in line with everyone else, nothing super great, but at the same time like not drastically underperforming. So it's good to look for like a moat and a competitive advantage. It's tough to be able to find that. I think from the Walmart aspect, I would think of their competitive advantage as being well diversified in the retail space from a wholesale and e-commerce and a traditional retail footprint. So they kind of have all three of those pieces as opposed there's a lot of other folks, Costco is just wholesale, Target is just primarily, I mean, they have e-commerce and primarily brick and mortar, but they don't have the discount wholesale aspect, Kroger, right? Just groceries. So I think Walmart is kind of the conglomerate for retail through all channels. So I think that's the exciting part about Walmart is they're well diversified in that respect. So anyways, I hope you found this useful. Leave any questions or comments below. Try to get back to you. Been pretty slammed lately at work, so a little bit slower putting out videos than I hope, but hope you found this useful and looking forward to the next one. Thanks.